What if I told you there's a legal way to pay $0 in federal income tax without breaking the law, using shady loopholes, or moving to a tax haven country like Switzerland, the Cayman Islands, or even Singapore? Sounds impossible, right? But it's not. In fact, it's the same strategy the ultra wealthy use year after year, every single time. That way they keep more of what they earn completely legally. And today, I'm going to show you exactly how they do it. So if you're tired of handing over massive amounts, massive chunks of your income to the IRS, this video is for you. This is your blueprint for change. Welcome back to the channel, Finance Philly, the place where smart people like you come and learn how to stop working for money and instead start making money work for you. We're going to dive into one of the most powerful, misunderstood tools in the world of wealth building and wealth keeping: strategic tax planning. Now, these aren't just loopholes or sketchy tricks, right? They're 100% legal, IRS approved, used by millionaires and billionaires, and now by people like you. I'll also share a bonus tip that the ultra rich rely on to protect their wealth. That way they can hoard it and pass it along in a tax efficient way. Here's why this matters. The IRS won't stop knocking on your door, but if you follow the rules, you can redirect thousands of dollars from your tax bill into investments, businesses, or your family's future. So grab a notebook, because this might be the most valuable video you've ever come across, or this year, and I don't say that lightly. Strategy 1, maximize your retirement tax advantage accounts. Let me ask you something very simple but critical. Are you maxing out your retirement account? Because if you're not just missing out on savings. You're giving away money to the IRS that you could legally keep. Here's how the wealthy protect their income right under the government's nose using the tax code itself. In 2025, the IRS allows you to contribute up to $23,500 to your 401k or your 403b, and $7,000 into a traditional Roth IRA account. If you're over 50, you get even more, and you get catch-up contributions. Now, if you add on a health savings account, it's a triple tax advantaged account, you're basically sheltering even more. If you got kids, a 529 college savings plan, that's going to help reduce taxable income and plan for their future. Let me give you a real-world example. A couple in Illinois, two middle-class earners, strategically maxed out their 401ks, IRAs, and HSAs while contributing to their kids' 529s plan. The result, they legally brought their adjusted gross income, AGI, so low they paid almost no federal income tax that year. No loopholes, no offshore accounts, just smart, legal use of the tax system. Here's the truth. The tax code is filled with incentives to reward behavior the government wants, like saving for retirement, investing in education, or preparing for healthcare. The wealthy don't skip these steps, they prioritize them. So if you're not maxing out these accounts, then what are you doing? You're not just falling behind on retirement, you're leaving thousands in tax-free gains and deductions on the table. And that's not just a mistake, right? It's an opportunity lost. Strategy 2. Here's something most school employers or even financial advisors never tell you. Not all income is taxed equally. In fact, the type of income you earn matters just as much, if not more, than how much you earn. Let's break it down. If you're earning a salary or are an hourly wage worker, your income could be taxed as high as 37% at the federal level, plus state taxes. But if your income comes from long-term capital gains or qualified dividends, you could only be taxed at just 0%. 15% or 20% based on your income bracket. That's a massive difference. Now here's what the wealthy do. They don't just work for money, they position money to work for them. Instead of cash heavy paychecks, many high net worth individuals get compensated in stock options, equity, or just assets. Why? Because when they eventually sell those assets after holding them for a year or more, they qualify for long-term capital gains treatment. That's far lower than the ordinary income taxes. Some of them strategically sell investments in lower income years. Others balance out gains with losses or time the sale of appreciated assets. That way, they have minimal tax impact. Now, they're not dodging the IRS, right? They're just playing the game in a smarter, wiser way. So ask yourself, are you building earned income or investment income? Are you working for every dollar, or are your dollars working for you? If you want to reduce your tax burden legally, you have to start thinking like an investor, not an employee. Because the wealthy didn't get rich, right? Trading time for hours, trading time for money. They got rich trading assets for freedom, and so can you. America was built for the wealthy. It is for the wealthy, so you have to play the wealth game the right way. Let me ask you something. When the stock market drops, do you panic or do you profit? Because the wealthy, right, they don't fear losses, they use them. Here comes tax loss harvesting. It's one of the most underrated tools in smart tax planning, and here's how it works. If you have investments that have gone down in value, you can sell them at a loss to offset the gains from other investments. That way, this reduces your net capital gains, which means less tax is owed. And even if your losses do exceed your gains, you can just deduct up to $3,000 per year against ordinary income tax. And that way you can carry forward the rest indefinitely, year after year. Let that sink in, right? In your worst performing assets, you can actually save money on your tax bill year after year. Now, if we take a step further with direct indexing, this is a method where instead of buying an ETF, you invest in individual stocks that make up the index. Why does this matter? Because it's going to give you more opportunities to harvest losses at the individual stock level. Even if the index as a whole is flat or up, platforms like Better Investment, Vanguard, Schwab, and Wealthfront offer automated tax loss harvesting. They do all this behind the scenes for you year round. Now, this isn't some Wall Street trick, right? It's literally IRS approved. These strategies can be used by anyone with a brokerage account and just a little awareness. The rich don't view down markets as setbacks. They see them as discounts and tax credits. So next time your portfolio dips, don't just sit there stressing out, right? Ask yourself, what good can come out of this? What can I harvest? Because sometimes your losses are worth more than you think. Strategy number 4. Now, let me introduce you to one of the most powerful and most misunderstood wealth strategies of all time. It's called buy, borrow, die. Sounds extreme, right? This is how multimillionaires and billionaires and trillionaires, if we have any, build and preserve generational wealth. It's legal and it's strategical. Here's how it works. First, the wealthy, they buy appreciating assets, things like real estate, stocks, or entire businesses. Now, these assets will grow in value over time, but instead of selling those assets and triggering capital gain taxes, they borrow against them. Banks are more than happy to lend them money, especially when you've got millions in appreciating assets as collateral. And here's the key. Loans are considered taxable income. So they get to access cash without selling, without paying a dime in income tax. That way, they can borrow money and use that to fund their lifestyle, buy more investments, a home, or even build new companies. Then comes the final stage. That when they pass those assets on to their kids and transfer it to their heirs. Here's the magic. The cost basis of the asset gets stepped up to its market value at the time of death. That basically means all those capital gains, sometimes worth millions, they vanish. The family pays zero taxes, and the next generation starts fresh, doing the same thing. No tax while living, no tax after death, just decades of compounding wealth and strategically leveraging it. Is it fair? Some say no. Is it legal? Absolutely. Because the tax code, right, it wasn't written by chance. It was written by people who understand money and who want to keep money. And this strategy is a perfect example how the wealthy don't just earn more, they keep more. Strategy 5. Here's a secret the wealthy don't often talk about. They don't just earn income, right? They engineer it. One of the smartest ways that they do this is by using specialized business entities. Instead of getting taxed as a regular employee, many high-income earners form LLCs, corporations. Why? Because they structure them in flexible ways that shift income into business profits, which can be taxed at lower effective rates. Plus, they can deduct legitimate business expenses like equipment, travel, software, and part of their home office. This means less taxable income, more financial control, and smart savings. It doesn't stop there. Many strategically register their businesses in tax-friendly states like Nevada, Texas, South Dakota, Puerto Rico, even though it's not a state, where income tax is minimal or zero. Combined with federal strategies, this can obviously dramatically shrink your total tax bill. And don't assume this is only for big corporations. If you're a freelancer, a consultant, a creator, or you got a side hustle, you can absolutely set up an entity just like this to optimize your earnings and reduce your tax footprint. The structure you choose, it can either cost you thousands or it can save you thousands. It's just based on what you want to do. So the next time you think of taxes, right, I want you to ask yourself, are you earning like an employee or are you building like a business? Here's a bonus strategy: philanthropy, trusts, and estate planning. You ever wonder why billionaires give millions away to charity? It's not just because they're generous, right? Charitable giving is one of the most powerful ways to save or reduce taxable income. Donations, they qualify. Nonprofits, it can be deducted from your income, instantly lowering your tax bill. But that's only the beginning. The ultra wealthy take it a step further, using tools like private foundations, donor advised funds, and charitable remainder trusts to retain control, build legacy, and avoid estate taxes. Then there are dynasty trusts. Right? These are designed to protect wealth for multiple generations while legally bypassing the estate tax trap. Here's the truth. It's not about giving everything away, right? It's about directing it where it needs to go instead of letting the government decide. Philanthropy, when done strategically, it isn't just about impact, right? It's about control, protection, and legacy. And this is exactly how the ultra rich preserve wealth long after they're gone. Let's take a moment to recap the 5 powerful strategies the wealthy use legally to pay little or even nothing in taxes. 1. They maximize tax advantage accounts like 401ks, IRAs, and SHAs. That way, they reduce their taxable income while building long-term wealth. 2. They shift income away from high tax wages, right, into lower tax capital gains and dividends. That way, they earn more while paying less. 3. They harvest losses strategically and use tools like direct indexing to offset those gains, turning market dips into tax wins, and more. 4. They borrow against appreciating assets. That way they can avoid taxable events while still being able to access large amounts of cash when needed. 5. They form LLCs and corporations. Sometimes they relocate to tax-friendly states, structuring income in smarter ways instead of harder. And finally, as a bonus, the ultra-wealthy have leveraged this: philanthropy, trusts, and estate planning to protect their wealth. That way they leave legacies and legally avoid estate taxes. Here's the big takeaway. The tax code wasn't obviously written to punish you, right? Maybe it was. But it was written to guide behaviors to reward people who invest, who save, who build, and who give. The wealthy simply learn how to read in between the lines. That way, they use the system the way it was designed to be used. And now, so can you. You don't need to be a millionaire to start using these strategies. You just need to start thinking like one. Because the truth is, what you don't know about, like taxes, is already costing you every year, every paycheck, every investment, every business you decide to start. But that all ends now. It's time to stop playing defense with your money and start building a future where your wealth grows legally, sustainably, and on your own terms. This isn't about loopholes, it's about leverage. And now that you know what's possible, the choice is obviously yours. And now that you know how the rich legally pay almost $0 in taxes, here's the real question. What are you going to do with the money you save? Simple. You invest it. So your next move should be investing it. And if you want to know how to invest, there's a video somewhere here on the best way to get started, a smart way to do it. And if this video shifted your mindset right, do me a favor, don't forget to like, subscribe, and join me here at Finance Philly, right, where your freedom becomes your legacy. Anyways, if you made it to the end of this video, thank you. I appreciate you, and I'll see you on the next one.